Adam Gower here at gowercrowd.com, and today you are in for a real treat if you're interested in buying or selling real estate or investing in it. My guest is Joe Ollis, chairman of the board and CIO at the Peak Group, who manages the Peak Housing REIT. What you're going to discover today is a very interesting angle to both buying and selling real estate. That's the 721 exchange. It's quite unusual and not commonly heard about. Joe is a world expert in this and has set up a REIT, and it was about that I contacted him. I was actually interested in learning more about what it takes to set up a REIT. But when I discovered the angle that he takes and the positioning that he has through 721 exchanges, that is what I ended up drilling down on. It is absolutely fascinating. You can find out more about Joe on the podcast page for today's episode at gowercrowd.com. While you are there, please be sure to subscribe to the newsletter. It is the only source anywhere that focuses exclusively on real estate crowdfunding for both passive investors and professional real estate veterans, and it includes everything you could possibly want to know about real estate crowdfunding, what's happening today, and comes with all the news and updates you could possibly want. Sign up there at gowercrowd.com. Now it is my great pleasure to introduce you to Joe Ollis, chairman of the board and CIO at the Peak Group. Here he is. Joe, what a pleasure to meet you. Thank you so much for doing the podcast today. We are going to be talking about REITs, a topic I know you know a lot about. So why don't we start? Well, let's start at the highest level, the 101 level, and then let's dive deep. So at that 101 level, forgive me for such a blatant question, what is a REIT?
So a REIT, very simply, is a real estate investment trust, and it is a definition of essentially an investment vehicle that allows a company to own real estate. And primarily it is used for either privately traded REITs or publicly traded REITs. And it is a combination of multiple investors coming together to buy real estate. And the key distinguishing factor really is a lot of the tax rules and the rules associated with a REIT versus standard funds. And
the difference between so you actually talked about tradable privately and publicly, but they're also non-traded REITs. So just explain the difference between public and private traded and non-traded.
That's right. So I think if you think about REITs right now, a publicly traded REIT is one that an investor can literally go to their Schwab or Fidelity account, type in a ticker symbol, and buy that REIT, buy that company. A non-traded REIT is one that is not publicly listed. So it doesn't allow an investor to actually go to their Schwab account and purchase that company or that REIT. A non-traded REIT is something that's privately traded. So it typically requires somebody to come in and sign a subscription agreement or an investment agreement with that company and then invest directly in that investment vehicle.
And a publicly traded REIT, does that suggest that REIT has to do an IPO or something? I mean, how does it work exactly that you get onto the market?
That's exactly right. You are taking your company, which is a real estate investment trust, and you're taking it to the public market. So you're literally launching it just like you launch an IPO of a company. And there's a lot of benefits for that, and there's a lot of reasons why people want to do that, and then there's a lot of reasons why people want to keep their REITs private. And I'm sure we'll dive through that.
We will do, because the next question I'm going to ask you is that I know that you set up a REIT. Actually, let me just have a quick look at it on the website here. It is the Peak Housing REIT Inc. So of all the options that you had to raise capital, why did you choose a REIT?
Yeah, that's
and what kind did you set up? Is it private, public, or traded, non-traded? Why did you set it up?
That's right. Okay. It is a privately traded REIT which means investors can reach out to us. And as long as they're accredited investors, they can invest directly into our REIT. We chose that structure because of one very specific special reason. So let me take a step back and kind of dive through what our investment is, and it will very clearly become why we chose a REIT.
Okay.
So our investment vehicle is for the aggregation of single family rental homes. So we right now, an investor who comes and joins us gets to be part of a company that owns 1,200 homes today and is adding new homes, new rental homes every month. So as we raise money, we're buying homes, but we're also building homes. So with those two structures, those two ways of our purchasing the houses, we could have chosen a fund model. We could have chosen a simple syndication model.
Mm-hmm.
Why did we choose the REIT? Well, it's because of this third reason. The third way we're acquiring houses is through what's called the UPREIT, or it's commonly referred to as the 721 exchange.
Okay.
Do you think your investors know what a 1031 exchange is?
I think a 1031 is probably, a good bet. I certainly do. But tell me, what's a 721?
So a 721 is exactly like a 1031, same tax benefits, except for instead of selling your property and purchasing another property, you're selling your property to a REIT, a real estate investment trust. When you do that, you exchange your equity for shares of the REIT.
I see.
That's supported with a REIT structure. So the reason we chose a REIT for our investment is to support these UPREIT transactions. And that the primary reason we did that really pertains to the macro tailwinds of single family rental houses and who owns those today. So the people who own those today really are looking for an exit. They might be selling and doing a 1031 exchange, or they might be selling and paying taxes. Now we give them a new option, which is to sell to our REIT in a tax-free exchange.
That's really interesting. So somebody sells their house to you, and I'm looking at some pictures on your website over here of houses that look like they must be multi-million-dollar houses, but I'm guessing they're probably not in California. So they're probably, some of them probably not multi-million, but somebody wants to sell, they want to exit a home that either they rent, so now we're getting into the weeds a little bit, either that they're currently renting or currently living in, they sell it to you, and instead of receiving cash, they receive shares in the REIT for the equivalent value of whatever the sales price was, and there's no taxable event at that point in time.
That is correct. There's no taxable event until they sell the shares of their REIT. So that is the beauty of this. It takes an asset that's usually an all or nothing when you sell it, and it creates little tiny shares that you can sell whenever you want. So you can control your taxes, control your estate planning, and have a lot more granularity when you do that. So it's a very powerful tool.
Now, can they, let's say somebody sells, and I'm just going to pick a number because I am in California, numbers are actually really like this. So somebody sells a house for $1 million, you buy the house for $1 million from them, and they receive $1 million worth of shares at net asset value, whatever the price is at that point in time. And they hold that asset they want to sell it in a year's time. They want to sell their shares. That's a taxable event. Can they 1031 out of the REIT into another acquisition, or are they done with that?
They're done. That is really the I guess one downside of that transaction is once it goes into the REIT, that's the final resting spot for that tax situation. And so once when they sell those shares of the REIT, they will be creating a new gain effectively, but they'll be capturing then their original gain that they invested into the REIT itself.
And so from that REIT, what are they hoping to, from your REIT, what are they hoping to gain apart from deferring taxes and being able to kind of spread them out over time? What
Yeah.
else? Income, presumably capital gain. What are the other benefits?
Yeah. So if you think about it, like a person who owns a single family rental house today, as a small landlord, maybe they own 10 houses, maybe they own 5, maybe they own only a handful. They're not quite as equipped as we are with 1,200 houses on our way to 10,000 houses to scale their operations. And that scaling operations helps both on the income side and the expenses side. So on the income side, and I think this is the really interesting part, if you're a landlord and you have 5 houses and one house goes vacant, you've lost 20% of your gross income. That's terrifying. So what do landlords do? They optimize with lower rents to keep tenants so they have like bigger occupancy. With a REIT with 1,200 homes, we don't mind having a few go vacant. In fact, we streamline to have between 93 and 96% occupancy, but that allows us then to really push to get to market rates. So a lot of times we'll be acquiring these homes, either purchasing homes, or we will be having homes come in with UPREITs, where the rental rate today will be 20 to 40% below what the market rate is. And if you talk to any multifamily operator, if they could find a building that has 20 to 40% like under market rents, that's the biggest value add opportunity ever. And we essentially have built an aggregation system to go and buy thousands of these. And so that's a big benefit of somebody coming and joining in. They're going to see their cash flow actually increase versus what they had invested with their original properties. On the expense side, then we're able to go and really streamline expenses. So we have a standard package for improvements. So same flooring, same kind of utilities, engagement, same roofing, flooring, everything. That helps us save a lot of money from the rehab or the renovation. And then on an ongoing basis, we have our own property management company. We have our own maintenance company. We can control that whole stack and control those costs. That again increases cash flow.
And this is obviously one of the attractions for people to sell to you, is that they still get the benefit of income and capital appreciation, but they have you managing the whole process for them. So when somebody, yeah, go ahead. That's basically it, right?
That's
when somebody sells
it, we're missing one also very critical component of this.
Sure.
Which is a small landlord can't get as favorable financing as we can within a REIT. And so if you think about financing, like a small landlord who has a decent job, they're receiving their W-2 income, they can get financing through standard home mortgages. That will take them up to a certain number of homes. After that, and I believe it's 10 homes, they can no longer get an additional mortgage on top of that. So they have to move to a marketplace for portfolio financing of homes that's much higher rates than the rates we're able to achieve when you start to have $100 million loans instead of $5 million loans. So for example, we're engaged right now with some banking partners for loans in the below 3% range. And that's fantastic. That increases our cash flow again for our investors.
That's really interesting. Actually, are you able to set those? How long can you set those terms for a sub 3%?
Yeah, that's a good question. So it all comes down to the asset management of the REIT itself. Okay. So we look at the whole spectrum of all the houses we want to or that we own, and we spread out based off of the strategy for those houses. So there might be houses that we want to touch, and we call it touching. We want to touch those assets on a yearly basis. A good example for that would be like, hey, we know we're going to increase the value of this property very quickly because we're going to rehab it. We're going to lease it. It's in a fast growing area. We might want to touch that asset next year to pull out some of the original equity that went into the renovation. So we might have those on 1-year terms. On the counter of that spectrum, we might have a community of houses that we're like, this is going to be the next up and coming area. We want to hold these things for 10 years plus. So we'll lock in 10-year loans at these rates. And so as my role kind of within this whole spectrum is to really manage that entire portfolio to make sure that we have great cash flow coming, we have the ability to touch the assets we want to, and we have a blended longer term fixed rate.
I don't want to get too deep into the debt side of it, but it is interesting. It's reminiscent to me of how you would finance a condo development, for example, where you have to have, there's all kinds of terms of how you exit and how much you can withhold when you sell something, et cetera, et cetera. But let me just ask you one final question on debt, because it is interesting. So when you do get a loan from a financial institution, is that portfolio wide? Is it a line? Is it assigned to each individual asset? Like, how does it work?
Yeah, so that's a great question. So we have a couple different buckets of money, of kind of financing, if you want to say the capital. That comes from something like Fannie Mae, which will actually assign a mortgage per house or per unit. It might come from what I call a mid-tier lender, which will also do that same thing. But then on the spectrum of the scale where we call a delayed draw line, so we would use cash to close and then we'd instantly put financing on, that's typically done on an equity pledge. So it will be the full REIT that essentially is responsible for it, not an individual asset.
The reason that I asked that was that some of our clients are taking as long-term debt as they possibly can, locking it in because they're concerned about inflation. Not concerned, but motivated actually by inflation. If you can set in place your debt at a super low rate in anticipation of rental inflation particularly, and therefore asset price inflation, then you're ahead of the game. So how do you manage that balance there between long-term low-cost debt and the possibility of inflation?
Yeah, that's right. Well, inflation, we believe, is going to inflation of rents, we believe, will far outpace inflation of the debt that we're going to be putting into place both this year, of course, but then 2 years and 3 years from now. So when we think about if my crystal ball says 3 years of extreme rental rate growth, followed by a stabilization for like 4 to 5 years, and then my crystal ball kind of cracks at that. But if you think about it, like, I'm less concerned of rates going from sub 3% to 5% when my rental growth is 5 to 7% a year.
Yeah.
And so that's and because on a capitalized value with these assets, a 5% rent growth is going to mean that there's a lot more equity available. Even if interest rates, cap rates associated with interest rates go up, there's still a lot of equity. So we do want to be able to touch a lot of these assets in the next couple of years.
Let's go back to that moment when somebody actually invests. Either somebody sells a home to your package of homes for $1 million, let's say, or somebody invests $25,000 with you, which is what I see as the minimum investment over here in the REIT.
Yeah.
So I'm interested. One of the big downsides that I understand about REITs is fees. So when somebody writes a $25,000 check, let's say, and invests, what is their balance on day one? Like, tell me about the fees that are associated with a REIT.
Yeah, that's a really good question. And that is oftentimes incorrect assumption that because it's called a REIT, there's really high fees. Now, historically, a lot of REITs, and especially private REITs, have charged what are called load fees.
Right.
So for an investor to come into the fund, they might be paying a load. So that load fee, in some cases could be very high, like 5 to 6%. Our REIT does not do that at all. And in fact, most REITs today don't charge that load fee. that just became such a turnoff to people, and especially in kind of the new realm where there's a lot more disclosure, people started to pick up on those REITs.
Right.
Our REIT has no load fee. So then you have to talk about the fees within the REIT itself. And that's where we like to do the apples to apples comparison of our REIT versus a standard fund, like a syndication fund or a fund that you can go and invest in. Typically, funds have an asset management fee. We have the same thing within the REIT. Our asset management fee is based off of our net asset value, or the NAV. We charge a 1.35% net asset value. That's the equivalent of a fund charging 1.35% on the money they raise. That's it for fees within the REIT. Just like a fund, our REIT also has what's called the general partner promote.
Mm-hmm.
So a fund typically might have a preferred return followed by a split. Our REIT does the same thing. We have an 8% preferred return, and then any excess profit above that 8% yearly is split, with 80% of it going to investors and 20% going to the sponsor. Just like with the standard fund that you see out there.
That's
And
interesting.
believe it or not, we modeled ours almost identical to the BlackRock privately traded REIT. Very similar mechanism, very similar fees, same promote structures.
Except they have 6 more zeros at the end of their REIT.
That's right. It's totally not fair.
Now, one of the, so you did actually mention, this is interesting. So at the end of the year, you do an accounting, and that's when you do your distributions. There's a requirement for a REIT to distribute a certain amount of profits, correct? Talk to me about how those calculations are made annually.
Yeah, so let me be clear. We do dividends on a quarterly basis to our investors. And our investors then receive at the end of the year, very quickly, in about a week or two after the end of the year, they receive their 1099 dividend statement, or I guess it's 1098 div.
Mm-hmm.
That dividend statement really is displaying how much they're receiving as dividends, but there's a key component in here which comes from the taxes, and I'm going to walk you through this. But first, let's answer your question. So your question was, what is the rules around REITs? REITs are required to distribute 95% of their income. That effectively is like an important measure, because if we collect income at the REIT, we have to distribute 95% of it. We can hold 5%, but in reality, that's not that much.
That's net income, right?
That's net income. Yeah. So here's the trick. The REIT is the owner of a limited partnership. The limited partnership is where all the real estate resides. At the limited partnership level, we use accelerated depreciation, we use expense management to really lower the income that's being produced at the operating partnership level. So when the REIT receives its K1 effectively, there's a lot less income associated with the cash that's being distributed. So just like with the fund, where a lot of people are like, oh, I want to receive a K1 because the depreciation offsets my income. We're using the same trick. It's happening at the operating partnership level. But then when the REIT distributes those dividends get characterized not as an ordinary income, but rather effectively return of capital. So the net result is investors are receiving a good dividend yield without having to pay taxes on all of it.
Now, that's interesting. Of course, anything that you get in taxes, you give back somewhere else, right? It's just the beauty of the IRS code, the tax code.
That's right.
So at some point, there is a tax event. And I noticed that your investment period is open-ended. So what is the kind of overall plan for this REIT? And at some point, you are going to exit, right? I mean, that is required. And at that point, all these deferrals will come home to roost. Is that right?
Yeah,
how will that work?
That is right. So you caught kind of our magic secret sauce here. So there is something happening within the single family rental realm. It is an asset class that historically has only been owned about 4 to 6% by institutions. So when I think of institutions, I think of the very large REITs like Invitation Homes, American Homes for Rent. I think of pensions. I think of very large private capital groups like PCCP. They only own between 4 and 6% of single family rental houses today. Yet the innovation that's happened in this industry over the last 10 years has made it possible for these scattered site homes to be managed more like multifamily. What that means is everybody wants to buy them right now. And so I think a lot of investors have probably read the news, seen a lot of reports, and they realize there's good tailwinds behind it. What we've created with the Peak Housing REIT is the most efficient aggregation platform there is. And our premise is we can go out and we can compile this large, say 10,000 to 20,000 home portfolio, acquire these homes at the equivalent cap rates of around 6 to 6.5%, take a bundle and liquidate that bundle through multiple means, taking it public, selling it to a larger REIT, selling large portfolios to pensions. There's lots of liquidity options. And here's where that arbitrage is that will make our REIT investors very happy. The equivalent cap rate of American Homes for Rent right now, do you want to venture a wild guess what it is?
I've got no idea. I mean, when you say 6%, that sounds incredibly high. I've got to guess it's significantly lower than that.
Yep. So the equivalent cap rate for American Homes for Rent today is 4.1.
Okay, I was going to say 4, yeah.
Yeah. So if you think about we're acquiring for 6, American Homes for Rent is trading for 4. That delta is massive.
It is massive.
And so there are now portfolios, very large portfolios that you're starting to see make headlines of portfolio sales. And there are some that are selling for even below 4 cap now. And so we think that we're just at the very start of this movement. And we're one of aggregators out there. We're a few steps ahead from other ones. And we do know that there's a very large opportunity for us to grow this. So that's our exit plan. That's effectively what we're building to right now.
Beautiful. Now, you have spoken only, as you should do, as the chief investment officer over there at Peak Housing REIT. You've only talked about the good things. What are the disadvantages? What are the pushbacks that you get? Like, what are the hardest challenges you have when somebody comes to you and says, I'm not invested because boom?
Yep. The number one reason is liquidity. So if you think about privately traded REITs versus publicly traded REITs, publicly traded REITs means tomorrow you can wake up and you can sell your shares. Now you're paying a premium for that. Just think of that 6% cap versus the 4% cap. That premium is called the liquidity premium. But that is the biggest advantage. So on the disadvantage side, when you think about it, how do you exit your investment? And by the way, as an investor, I always go through this process. Like the investor goes, 1, are you for real? Or are you just stealing my money? Right. So as soon as you can overcome that, like that's
Trust.
Step 1, right? It's trust. That's right. Step 2 is how much money can you make for me? Makes sense. Step 3 is always, how do I get my money back? And with a privately traded REIT, that liquidity is much more difficult than a publicly traded REIT. And so our plan, the way we've structured this, is we really ask investors to come along for at least a 5-year investment cycle. That's what we think it's going to take for us to execute our strategy to get to the point where we have these larger liquidity events. And it doesn't have to be something as extreme as taking it public. It could be that we take a portion of the portfolio and sell it to redeem shares. We take a portion of the portfolio and we recapitalize it with one of those large institutional partners who buy out shares. So there's a lot of flexibility along that, but it takes time. And so effectively to join a REIT, and we've only been around for about 2 years now, so we're really young in the terms of REIT standards. Mm-hmm. But to join one of those, you're effectively joining a startup. You're along for the ride. You should see bigger capital appreciation for that, lack of liquidity. But that's really the big downside.
What are the biggest challenges that you face today?
So I would say, there's a ton of them. Right now, I'd say scaling is really hard. So we've been growing so quickly that we're trying to get our processes in place to support that. So a great example is we just bought 300 houses in a new market. And when we jump to that new market, it means we have to go and instill our property management processes, our repair and maintenance processes, all of our software and skills into that new market. And that honestly takes a lot of time, and it's a lot of hard work. So from that standpoint, that's one of the biggest challenges we're facing right now.
And what about finding products, Joe? I mean, I sit around, again, I'm in California over here. I have a friend in North Carolina who bemoans having sold his house a year ago. He said that having owned it for 18 years, it had gone up 2% a year or something. And now it's gone up. I'm in California where things go up 2% a month.
Yeah.
Prices and demand is so high. How are you finding product?
Yeah, so we actually do quite a few different things, and I don't want to give away all of our secret sauce in that because it is so competitive.
Right.
But I'll share some of the methods that we use that a lot of other people use. One of them is Mls Data Feeds. There are systems that you can build on top of that will essentially parse through MLS data feeds to find houses that meet certain investment criteria.
Interesting.
And that's a very effective way to find that there might be a house that is slightly older, needs renovation, probably wouldn't sell to an owner user because an owner user wouldn't want to be buying this. We'll buy it, throw it through our system, renovate it, get it up to a really high quality standard, and then have it leased out. So that's been a pretty powerful mechanism for that. We also still utilize what's called the wholesale network. And a wholesaler is just like somebody that's a fix and flipper. And so there's kind of the spectrum. A wholesaler might start and do something like they'll find a house that meets a lot of great criteria. They might find it off market. They'll call us and say, hey, I have this house for sale. Do you want it? We'll say, ooh, looks pretty cool. We'll buy it for this price, which might be $5,000 more than what the wholesaler has it under contract. And so that's an incentive way to get kind of these off-market deals. And that helps a lot with portfolios.
Right, where you're building. Yeah, go ahead.
And then we have a couple of what we call secret sauces that have to do a lot with more effective advertising. And I don't want to talk about it too much because
that's fine. You're the guy with all the signs around town that say, I buy homes.
No,
is that you?
No,
with an 800 number.
Yeah, we buy ugly houses. So those are wholesalers effectively. And as funny as that industry is, and I still laugh every time I see those signs, it's highly effective. And I love it because what's really happening in that is they're converting houses that have really been unloved in locations that are denser, high quality locations into great rentals. So, I mean, it's a good system, and we definitely have bought from those type of groups.
Joe, I have another 400 questions here, but we're out of time. So I'm actually just going to ask you, if you don't mind, 3 sign-off questions, rapid fire sign-off questions that I ask all of my guests. Eventually, I might put this into a book or something. We'll figure something out anyway. The 3 sign-off questions. First one, what are your key daily habits that keep you productive and successful?
I wake up at 5:50 a.m. and I work out in my garage listening to a podcast of the day. I go and eat breakfast with my kids, help them get ready for school, and then I'm at work by 7:30 a.m. That is like clockwork. I work out every single morning.
Gosh, that's the habit I need to get into. I think about working out every single morning. Second rapid fire question. Joe, what's been the hardest lesson you've learned in real estate?
That brokers are not aligned with buyers. I think there could be a whole podcast on that. But learning that a broker is there for a commission, trying to make a transaction occur, does not align them with the buyer's objective or the seller's objective.
So you say that there's a whole podcast in that. When I started podcasting, however long ago it was, the entire series focused on exactly that. The principal agent conflict is That's what right. academia calls it. It's a fascinating area. And it's a very interesting area. So I'm glad that you mentioned that. If you are interested in hearing some of the top minds discuss that, the first series of podcasts that I did, they are appallingly badly produced because I was a novice and I was editing sound waves and all kinds of things, and I tried not to say anything myself. I just let them talk. I was, a total neophyte to podcasting, but I interviewed professors around the country who'd written papers and analytics proving this thesis, actually, not just hypothesizing, but actually using data, some very interesting studies. You might find it interesting.
I'd love that.
The last of my three questions. So what is the most important thing someone thinking of investing in REITs or in your REIT, what should they keep in mind? What should they be looking for?
So I really think that as an investor, aligning your goals with the goals of the REIT. So that might be your belief in the tailwinds of single family rental housing, your belief that there is an opportunity to aggregate houses right now because it is an emerging institutional asset class, and that you're willing to go along for that bet for at least 5 years. That would be the three things that I'd want an investor to really think about before choosing to invest with us.
Joe Ollis. I pronounced that right?
Yeah, you did. Good job.
Joe Ollis. Right. Now, on your website, you are CIO, Chief Investment Officer of the Peak Group. On your LinkedIn profile, you're Chairman of the Board. So I'm not sure. Both right. So let me sign off properly. Joe Ollis, Chairman of the Board and CIO at the Peak Group. Thank you so very much for joining me on the podcast today.
Thank you. It's been a pleasure.
That was Joe Ollis, Chairman of the Board and CIO at the Peak Group, discussing the Peak Housing REIT and 721 exchanges. Fascinating, right? Be sure to go to gowercrowd.com and sign up for our newsletter. It's the only source of its kind that focuses exclusively on the real estate crowdfunding industry. It's totally free and it covers all the latest news, updates, and information that you could want on the industry, all there at gowercrowd.com. Thanks so much for joining me today, Joe Ollis, Chairman of the Board and CIO at the Peak Group. And thank you for listening in. That's all for today. Be well, stay safe. And for now, this is Adam Gower signing off.